This is for educational purposes. There's nothing being solicited. I am a investment advisory representative with Financial Network Investment Corporation, and securities and investment advisory services are offered through Financial Network Investment Corporation. And let's talk a little bit about the market emotions. And for those of you who've been around a while, you've seen me present this slide. When it relates to the equity markets, think about gauging the emotions of the investors that participate in the stock market as we move through time. And this is the cycle. Over and over again, this is the cycle. So I can tell you that the lowest point in the marketplace was in March of '09, where the S&P 500 was trading at 666. And the prior high was in 2007, around the November period, where the S&P 500 was trading around 1,500. And if you think about the attitude of the people that invest, this is how it works. When things are really doing well and everything's booming, the tech market's booming or the real estate market's booming, there's thrill and euphoria. And when things begin to slow down and there's some disappointments with earnings, you get a little anxiety, maybe a little denial that this is really as bad as it is. And then things continue to change and get a little worse, and that changes over to fear. And when you get to fear, you start seeing irrational behavior. You're seeing people that have an understanding that to meet their long-term goal, they need to make 7%. And they take everything they've got and they put it in something that makes 2% because they're scared. I'm not saying it's wrong. I'm saying this is just natural. This is the emotional cycle of how people invest. And then markets pull back more, and then you get more desperate type things. You see companies really doing creative things to try to meet their earnings, and the creativity creates challenges on their balance sheets. Then you can see panic and capitulation. Capitulation, for those that don't know, is when you say, I don't care what it is, I want out. And in my career, there's been two of those events for sure that I can remember. A week solid of the phone call coming in from a number of people. I don't care what it is, I want out. I don't care if I have a government bond that's up 6%. I don't care if I have a small cap stock. I don't care what it is, I want out. I am scared. I can't lose a penny. That's capitulation. And then shortly after you do that, and then you get your statement, and you realize, okay, now that I'm out and the market's down, this despondency. I'm never going to reach my goals. That translates over to depression. But you have to understand emotionally that those are the most attractive times to buy equities, or the most attractive times to buy things that are priced down. But it takes an enormous discipline, and it takes almost a constitution that very few people have. And then you get past that. You figure, okay, if this was March of '09, think about 6 months ago. Things stopped getting worse. They weren't getting better, but they stopped getting worse. And we saw the Christmas season come along, and we saw consumer spending come back alive. We saw the automobile industry, after a few kicks with some free money and some cash for clunkers or whatever, we saw some sparks, and we ended up in 2009, 2010 going through a period of hope. And now when you look at the market, you could almost say we're somewhere between relief and optimism. And so in my view, this is a great time to talk about what we need to be thinking about in the next couple of years, because as we get much past this optimistic general feel that's in the marketplace today, not the economy, not the people we know down the street that are out of work, not the people that can't sell their house, but people who are investors that are investing in companies that are creating profits, and they see it in their statements. There is optimism brewing in that group of people, and it's very important to understand it's a disconnect. Okay, I'll come back to that in a minute, but as we get prices continue to improve, you need to understand that there's where some discipline is needed. It's just as critical to take money off the table when things are higher than they should be as it is to remain invested when they're cheap. And psychologically, it's a problem. Because when you get the statement, everything's looking good, hey, this is great. In fact, I can't guarantee anything, but I would be shocked if I don't get a couple of calls in the next 2 or 3 months that says, hey, Lynn, we're really excited that, we're back at all-time highs, our accounts are in good order, but, I noticed that the market's up, 15, and we're only up 10. And, we need to do something about that. That's the conversation, not the market's down 30, what do I need to do? And I'm scared. So be understanding that we are naturally going to get more and more cautious as prices rise rapidly. The S&P 500 index is a widely recognized measure of the U.S. stock market's performance. It is an unmanaged index of 500 common stocks chosen for market size, liquidity, and industry group representation, among other factors. The Barclays Capital U.S. Aggregate Bond Index is an unmanaged index that covers the U.S. dollar-denominated investment-grade fixed-rate taxable bond market of the SEC-registered securities. The index includes bonds from the Treasury, government-related, corporate, mortgage-backed securities, asset-backed securities, and collateralized mortgage-backed securities sectors. Barclays Capital U.S. Intermediate Government and Credit Bond Index is an unmanaged index that includes U.S. Treasuries, government-related issues, and investment-grade U.S. corporate securities with remaining maturities of 1 to 10 years. Barclays Capital U.S. Long Government Credit Bond Index is the long component of the Barclays U.S. Government and Credit Bond Index and is a widely recognized index which features a blend of U.S. Treasury, government-sponsored, U.S. agency, and supranational mortgage and corporate securities limited to a maturity of more than 10 years. The Barclays Capital U.S. Corporate High Yield Bond Index is an unmanaged index that covers U.S. dollar-denominated, non-investment-grade fixed-rate taxable corporate bond market securities. Citigroup 1-month Treasury Bill Index measures monthly return equivalents of yield averages that are not marked to market. This index consists of the last 1-month issues. Returns for this index are calculated on a monthly basis only. The Consumer Price Index is an inflationary indicator that measures the change in the cost of a fixed basket of goods and services, including housing, food, electricity, and transportation. The Sharpe ratio is a measure of historical adjusted performance calculated by dividing the fund's excess returns by the standard deviation of those returns. The higher the ratio, the better the fund's return per unit of risk. Investors cannot invest indirectly into indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and/or fees and expenses associated with investing.